just letting everybody know I'm recording this session. I'll be delivering the lecture live. So if you wish not to be recorded, please just let me know by sending me an email at a later time, and I can try to take out any part that you're speaking. So today's lecture is about financial preparation for entrepreneurial ventures. So in other words, how do we present the bare minimum financial statements that can capture the imagination of a venture capitalist and really tell him, okay, this is a sound business, I can make money from this. And the only way you can do that is to have very good financial statements. And of course, because we have limited time, I'm not saying you should prepare several pages of these financial statements, and I'll tell you more or less what to focus on for your business plan. Okay, so the first financial statement, by the way, show of hands here, who among you here are from accounting, who are taking an accounting unit? Sorry, not an accounting unit, but the accounting course. Sandesh, are you in accounting?
I did accounting before.
Okay. Anybody from accounting? Sadman?
Yes.
Ivan?
No, I'm from management.
Okay, good. Ivan?
Yes.
You're accounting?
Yep.
Okay, good. So, Daniel, you're in accounting?
Yeah.
Okay, very good. So the ideal is if you team up with someone who is from management or marketing and you're from accounting, obviously the accounting person will be focusing on the financial statements. It'll be the person who will really be working on this. So the balance sheet represents the firm's financial condition at a certain date. So usually it's like a photograph of the business at a particular time. So if we're saying 31st of December 2019, then it's the state of the company at that particular date. So it details the items, details the firm's assets and the liabilities, whatever debts or liabilities that the firm needs to have is listed down in the balance sheet. Sorry, let me just pause for a moment. Okay. So the basic reason why you have a balance sheet, it basically shows the net worth of the firm and how liquid the firm is. So in other words, if the business falls apart or it has to end its operations, how easy is it for the company to pay off its debts, or will the company become so insolvent that it cannot pay debts? And basically that's what we mean by liquidity. How easy is it to shift its assets into hard cash? So the basic formula is assets equals liabilities plus owner's equity. I'm sure you guys have learned this from your accounting 101. Sorry. An asset is something of value that the firm owns. Liabilities are the claims that creditors have against the firm. And owner's equity is the firm's or the owner's interest in the firm. So if you have decided to put in $50,000 of your own money, that means that's your paid in capital. That's the amount of money that you put into the business. And if you have a limited liability kind of company, that means that you're only liable up to 50,000. So beyond that, your creditors cannot run after your personal assets. Come on, doesn't something be working? Come on, there you go. So here's an example of a balance sheet for the year ended 31st December 2018. You see the assets listed down there. Receivables are part of an asset, and basically you don't have that in your bank right now, but it's something that people owe you. right? So I'm not going to go into too much detail. Fixed assets are listed down here. So if you have any equipment, that will be listed down in this section. You should also be depreciating your equipment. If you've got a building, for example, or if your equipment is meant to last 10 years, then you may think about depreciating that over 5 to 10 years. All right, so when we say less depreciation here, it means that originally the value of your equipment was 410,000, and because of 1 year of depreciation, you minus that depreciation from that value of the asset to bring it down a bit. Okay. Now the liabilities part, this is the amount of money that you owe your suppliers, for example. Notes payable might be in terms of a bank loan or a loan payable. Total of that is here, listed down here, total liabilities. Oops. And of course the equity. And equity is the amount of money that you put in. If you have any retained earnings, the retained earnings are basically the money that you've earned the previous period that have not been used for operations of the company. So that's basically enters as part of your equity. So you've got your owner's liabilities and equities here, 1.6 million. It should be balanced with your total number of assets. That's why it's called a balance sheet. Go back one slide. As you can see, assets equals liabilities plus owner's equity, which means it should be balanced. Okay, my favorite financial statement, the income statement, also called a profit and loss statement, provides a statement that shows the change that has occurred in a firm's position as a result of its operations over a specified period. Generally, income statements are, you can do that every month if you want to, but for official purposes, usually it's every year, and it just shows you the income that you've been able to garner for the period. I don't know why it's not moving. Come on. There you go. It shows you the income or the revenues. So revenues is the same as sales. And expenses, the cost of producing the goods and the services. And you might also be including here the depreciation of your assets, which can be inputted as an expense for that period. And the resulting equation after you minus your expenses from your revenues would be your net income. It's pretty basic stuff. I'm sure all I'm doing now is trying to refresh your memory if it's maybe been a while since you haven't taken your accounting. Okay, so here's a typical income statement and how that looks like. Your net sales are over here. So net sales are simply your gross sales minus any returns and allowances and discounts that you may have granted. Your cost of goods sold, which is technically, especially if you are a tangible object manufacturer or you sell tangible objects. So you might buy something at $30 and resell that for $50 with some value added. That $40, or should I say 30? That $30 would be your cost of goods sold for every item. And if you multiply that by all the items that you've sold, that is your total cost of goods sold. So it includes all the purchases that you've done, plus the inventory that you might still have that has not yet been sold. Remove the inventory. That inventory, by the way, is the beginning balance of the inventory. And if you minus your level of inventory at the end of December, by the way, this is probably wrong. It should say 2018 and not 2000. There's a typographical there. you will arrive at your cost of goods sold. So again, let me reiterate that cost of goods sold is not your entire inventory. You should minus only the products that you actually use to sell for that period. So whatever ending inventory you have does not form part of your cost of goods sold for the period. Operating expenses are indicated there as well. Selling expenses, administrative, total operating expense, and operating income. Now, some of these expenses might be fixed. For example, some of your administrative expenses might include your utility, which no matter how many products you sell, you're still paying the same amount of utilities, like for uh, power, gas, light. Um, Rent is also something that does not increase depending on the number of products that you sell. So that's what we call a fixed cost. No matter how many products you sell, that fixed cost will remain the same. If you sell more of the product and your expense also goes up, that means that is a variable expense. And that's an important matter to take up because that's how we'll determine your break-even point later on. Okay, so income before income taxes is there. You minus your income tax to arrive at your net profit. All right, so cash flow statement is very important. And the reason for that is it's similar to the income statement, except this one only acknowledges the actual cash that you're receiving. So in a nutshell, if you sold $10,000 of goods, but you only were able to collect 5,000, that means your cash flow is only 5,000, not 10, because the 10 is still in receivables. You're still waiting for that to be for your customer to pay you. On the other hand, if you have a debt, like for example, you owe the bank $10,000, but you have not yet paid that amount because perhaps it's not yet time to pay, then you don't reflect that as an expense. You reflect that you only reflect the actual cash that has been released to pay for that loan or for that item. So if you're doing a venture, the cash budget may be the best approach for an entrepreneur starting up a venture because you need to be very cognizant of how much cash you have, how much cash you're actually earning. It doesn't matter if you're selling something but you're not getting any money for it. You know, somebody might say, yes, I buy this, I owe you $10,000, but if he's not going to give you the cash, then in a cash kind of budget, then it doesn't really count. Okay, so preparing financial budgets, it's a very powerful tool for the entrepreneur to use. You need to have an operating budget, which I will require you guys to do for your business. You need to have a cash budget, a statement of estimated cash receipts. This one is optional. You may not necessarily need to do this for the assignment. Of course, if you're doing a real business, you would need this. But for our purposes, I'll stick with an operating budget. And I also will not require a capital budget. So the most important thing is a statement that estimates your income and expenses over a specified period of time. So here is an example of a budget, and an operating budget always starts with a sales forecast. You try to estimate how much sales will you be making in the next couple of months. For your purposes, I'll require a 5-year projection. Doesn't have to be monthly, just make it annually. So for 5 years, year 1, year 2, year 3, year 4, year 5, what are your sales projected to be? Obviously, on year 1, you're starting out, your sales should be a little bit lower, in fact, a lot lower than in year 5. So this is just a way to forecast your sales if you've already, Vipul, you've got your hand raised. Yes.
So David, this all the sales and whatever the expenditure gonna be, it's gonna be uh, like,
Projected.
so you have to do it by yourself. Do you need to research it, or how
No,
it gonna
that's basically just your estimate.
like the assumption?
Of course, your estimate has to be well founded. So you need to support your estimates with something. I mean, you can't just pluck out a figure in the sky and say, I'm going to sell $100,000.
No,
Show
no,
me
just
some, show me some computation of how you reach $100,000, for example. I'll give you an example. If you're in a restaurant, right?
yeah, yeah,
And you need, you've got, you want to estimate your yearly sales, your annual sales for the first year
yeah,
or for the second year, then you need to know, give an example, sorry, not example, figure out how many customers do you think will be coming to your store on a daily basis.
yeah,
And then how much do you think these people are going to be spending? So if let's say you say $15, it depends on what kind of a restaurant you're thinking of. If it's fine dining, then maybe you're looking at $100 per person, or maybe
yeah.
$50 per person. But if it's say $12 per person, and you're expecting 50 people or 30 people to come to your restaurant every day, then
Yeah.
multiply 30 by
Oh,
$12, and that is your daily sales. Multiply
oh,
that by say you're only open in the weekday, that's about 260 days a year.
oh,
So
yeah,
that would be your annual sales. Okay.
yeah, all good.
You can also forecast based on existing sales. If you're already a business that's running and you already have these sales and you're saying you're going to grow by about 5%, then all you need to do is multiply each month's sales by about 1.05 to arrive at a very simple forecast for each month. Okay. But unfortunately for you guys, you can't forecast this way because you don't have any historical figures. Let's go on. Am I still recording? I hope I am. Yes, I am. Somehow this PowerPoint is very stiff. It doesn't respond right away. Okay, so this is an example of a like a purchase budget, and the reason why we're doing this is so that we understand how much inventory we need to buy. So if you're a restaurant, obviously you need to buy your vegetables, people, because I know you're a vegan restaurant. So your vegan restaurant, you need to think about the amount of vegetables you need to buy on a daily basis, or even on a monthly basis, and start to try to project how much
Yeah,
money you'll need to have to be buying these supplies. So there's your beginning inventory, your purchases, and your cost of goods available. So all of these are basically projections that extend monthly. Again, this is not something I will require for you at the moment. Projections will be annually for 5 years, more or less. And that's basically just an example of a gross profit. It's gross profit because the person has not yet minus his fixed costs in this particular example. So if you are a manufacturing concern, you need to be able to project how much your production should be in your factory. And the way you would do that, of course, is to use your sales projections, which was we did earlier, right? So we go to the sales. Okay, there's your sales forecast. How many units does that represent? You need to use that to compute for your projected sales for every month per unit. This is not in dollars. This is per item that you're selling. And then you basically, if you have any ending inventory from the previous period, you can add that in. You've got a desired ending inventory. This is how much you want to be left with. This is what you need to be available to use as part of the sale. And this is your less a beginning inventory I was talking about from the previous term. And therefore, this is how many units you need to manufacture for that month of January. Okay, so the bottom figure here represents the number of items you need to manufacture, and that's why it's called the production budget. Any questions so far? Okay, let's move on.
None.
Okay, cash flow. As I said, a very important document. Because we don't have that much time, I'm not going to require this to be in your report, but you can if you want to. And in a real situation, you would probably need to have a cash flow budget, depending, of course, on for some companies, for example, who don't plan to have accounts receivables, or maybe they are on they usually pay their liabilities right away, or if you don't have any liabilities from the bank anyway, then maybe you don't need a cash flow budget. But if you do have loans from the bank that you need to pay, if you have suppliers that you need to pay, if you've got receivables that you have to collect, then a cash flow budget is a really important document to have. So preparation for that, you need to have an idea on how much cash sales you will have. This does not include, of course, the people who are borrowing or not borrowing, who are not paying their sale right away. So if you've got a customer, you give him a 60-day or a 30-day period to pay for his sales, then that will not be included in the particular cash sales. It will be included after when it is due, and when you're paid, that's the only time it is included into your statement. So you need to know your cash payments received on account. So the payments that you need for your loan, for example, and any suppliers that you need to pay perhaps ahead of time. If you need to pay it ahead of time, it has to be reflected in the cash flow budget. You also need to know your minimum cash balance. So this is a expense budget. I think this is not the cash flow expense budget. So I'll take one more slide. Yes, so this is the cash flow budget, which reflects the sales for the month. So 315, you've got the current month sale 252, a collection of 82 from a previous month, and a collection of 26 from 2 months back. If you add all of that, it adds up to 360, and so forth, so on. So here, whatever sales that you make, you add that to, sorry, this is the current month sales. So whatever you're making for that current month, you add whatever you've collected from the previous months, and that will be your cash flow sales. You'll notice that your cash flow sales might be very different from your actual sales. The top line here are your actual sales, but because this does not reflect the actual cash in your bank, you should not be reflecting that. So the way you would reflect that again is your current month sales plus, you can see that 388 was your current month sales, but only 294 was actually collected of that 388. So that's the cash coming in. The cash going out, which is the disbursements, you also have to reflect in the same fashion. So you may have purchased $331 worth of items in March, but you only actually paid 248 of that. You may not have paid, you still have some payables that you need to pay. This is a payable that you need to pay from last month that you already paid for that period. That's why it's reflected here. So if you put these together, you put in your cash receipts, you come up with, and you minus your disbursements, this will be more or less the resulting cash flow budget, which has all the receipts less the payments that you had to do for that particular period. So you can say that this is your real earnings for that period, for each period, the very bottom line. That's the amount of cash that actually came into your business, or the amount of cash that you actually have for your business. Okay, so for our purposes, for our assignment, this is the most important thing to consider. Pro forma statements. Pro forma statements are projections. This is what you expect to happen when you start your business. And that's what we mean by pro forma. Okay, so ideally you should have a pro forma balance sheet, but as I said, that's going to be optional. I'm not going to require that from you. You can if you want to. But to me, the most important thing is to try to determine your income statement, and this is the one, your pro forma income statement. Let me reiterate, I'm not asking for a monthly income statement. I'll just ask you for 5 years. You don't have to break it down per month. You can if you want to, but for the report itself, just give me your first year, your second year, your third, fourth, and your fifth year. Okay, so this is what it should look like. More or less what I'm seeing here should be in your report, except here it'll be year 1, year 2, year 3. So here's an example of a balance sheet projection. Again, this is optional, but here is what I want. I want fiscal year, fiscal year, fiscal year. And again, these are all projections, assuming this is a year after this year. So 2021, 2022, etc. Okay, break even. This is the fun part. And I hope you guys have ball pen and paper, because we're doing a little bit of exercise to arrive at our break even. Does anybody know how to do a break even analysis here? The accountants, you should know how to do this. A little bit confusing, but let me try to put it in very simple terms. So the most important thing you need to have is to understand your contribution margin. So contribution margin means you get your selling price, your net selling price of an item. Say if you sell phones, maybe you're a small mobile phone shop in a mall. For now, if you're in a mall, then not very many people are buying from you, unfortunately. But let's assume things are normal and you are selling your mobile phones in your shop. You need to know what your selling price is for the item. And that's basically your net. So don't include credit card charges here. So you basically net of credit card charges. So if you're selling an item for, say, $100, that's your selling price. How much did you buy this item from your supplier? So if you bought it for $50 and you sold it for $100, your contribution margin is $50. Correct? So that's what we mean by the selling price minus your variable cost per unit. $100 minus $50 equals $50. That's your contribution margin. So if you think about it, if your selling price minus your variable cost per unit is 50 and you sell 100 units, then you're making $5,000. So S stands for the sales in the number of units. By the way, this can be over a year's time. So for example, break-even point for 1 year of operations, and you may have sold, say, 5,000 of these units. 5,000 units times a contribution margin of 50 is about, what is that, 250,000? Math whiz, please. Are you still with me, or are you guys falling asleep? Cyril, are you with me?
Yes, I am.
All right, good. And then you basically minus your fixed cost from that. That's basically your profit, right? So if you want a break even, it means you want to know how many things I need to sell to get a profit of 0. So the minimum sales I need to make so that I'm not losing any money. I'm paying for fixed cost, I'm paying for my variable cost, and if I get a 0, that's the minimum I'm aiming for. And that's usually a good thing to have on your first year, to try to determine how much of whatever items I'm selling will I need to sell in order to get the minimum break-even point. Of course, we want to sell more than 0, but it's good to know what that break-even point is. So I would put my profit into 0, and I will have a resulting formula as such. So in order for me to figure out how many of that gadget I need to sell, I need to get my fixed cost and divide that by my contribution margin, which is selling price minus variable cost. Are you guys with me?
Yes.
Yes.
It's not too hard. And look, this is something that you can easily find a formula for. We're not going to have an exam which exams you on this anyway. So just refer to this to be able to compute for your break-even point. In fact, let's try to do an example right now. I hope this works. So, assuming you're a tailor and your name is Paul, and you make suits, business suits as a living, okay? And so you're starting your business, and you know you're going to spend about $250,000 on annual fixed costs. That includes your rent, the salaries of your tailor, your electricity, etc., your water, and your gas bill. So you spend about $250,000. That is your fixed cost, and they're called fixed because it doesn't matter how many products or how many suits you sell, but you still need to pay that at the end of the year, $250,000, even if you're not selling anything, or you're selling maybe 10 suits. So to make one business suit, Paul estimates he will need to spend about $100 for fabric and labor for that particular suit. Okay, and he plans to sell at an average of about $300 per suit. That is the selling price. Can you guys compute for the break-even point?
So the variable cost is 100, right?
Looks like it. Yep,
Yeah,
$100. Try to do that myself. So the fixed cost is $250,000. Divided by, what's the contribution margin? Nobody knows the contribution margin?
So its contribution margin is 300 minus 100, right?
That's correct. So
200,
yeah. And so therefore, what's the break-even point?
So the break even 1250.
So what does that mean, $1,250?
No, he needs to sell 1250 suits
That's right.
in order to make it balance.
So how many suits? He needs to sell 1,000. Well, here you go.
1,250.
Yep, 1,250 a year. Now the other question is, how many suits per day?
Divided by 365.
That's a good way to see it, but you have to consider how many days are you open as a tailor, right? Are you open 365 days a year? My goodness,
No,
you're an amazing tailor.
No, normally tailors and the tailor guys normally like in general, they open like 7 days a week.
Really?
It depends on where you are. I guess in Melbourne, maybe not 7 days a week, but yes, you could say if you were in another country,
No, because
you could use 7 days.
he's spending $250,000 in annual fixed cost, and that's a huge amount for the first year. So for the first year of time, you will not try to keep like have a holidays like you take
But then your
close for Saturday, Sunday, or
but
You
then
need to
your variable
consider,
cost.
Sandesh. You need to consider those, Sandesh. If you're operating in Australia, the rates for weekends are very expensive. So you'll have to pay your person weekend rates, which is going to be quite expensive. But that's fine. It doesn't really matter. You can divide it by 365. If you're really going to be selling 365 days a year, you through Christmas and New Year and Easter, etc., which is probably not what do you call this, a good estimate. But if let's say you're only doing 5 days a week times 52 weeks, that's roughly 260 days. So 260 days, how many suits, more or less?
4.8 or 5?
Correct. So about 5 suits a day. Okay, which that might be doable. 5 suits a day to break even. Okay, so that's how you compute your break even. And by the way, what's the annual revenue that you need to have to break even?
So 1250 into 100, right? No. Oh, sorry. 1250 into 300.
Yes. So 1,250 times 300.
Yep.
How much is that?
375.
375,000.
Yep.
Right. So more or less, that's how much you need to sell to break even in terms of dollars. Okay, so try to do that formulation. I know it's a little bit difficult. For example, if you're doing butology, and so you have many different products.
Yeah.
One approach to that is
Average.
to get an average. Yeah, get an average sale. You can also average one customer. For example, how much does one customer will spend on your store? What do you expect? If he spends $100 in your store, then that's your selling price. And then
Wait, sorry.
Go ahead, Sadman.
So can we do something? Say suppose like we have 3 products. Can we like average those 3 products and come up with the selling price?
Yes, you can. You can have an average selling price if you have 3 products. Same thing in a restaurant. You've got a menu, you've got different items, but just try to come up with an average sale for a customer. So he might spend $12. Part of that will be a drink, part of that will be a piece of bread, whatever it is. And then try to estimate how much the cost will be for that particular sale. That will give you your variable cost, which is the $100 that's mentioned here. And then you can do some sort of a computation. Did you get it?
Yep.
Okay, good. Come on. It's got a stiff neck. It doesn't want to move. Or maybe that's my last slide. What's going on? No, just one more slide. It doesn't want to move. Bit of a hang there.
He's probably tired too.
Yeah, I'm tired. Last slide anyway, so we're done. Look, there are many financial ratios that you can use, and a lot of these are usually quite important when you're already running your business. So for your purposes, because you're simply projecting it, and you're trying to have a forecast of what's going to happen in the next couple of years, I think the most important financial ratio that you must have is return on investment. And you will need to know this ratio because this is a question that your investor will be asking you. So if I plunk down $100,000 as an investment in your firm, what will be my return? How much will I make out of that? So you need to have that sort of idea in mind and compute your projected net profit before tax and divide that by your net worth or your equity, in other words. And that would be your projected return on investment. And that's it. Any questions about the financials? So to recap, what I'm requiring you to do is the income statement, a projected income statement. That's the most important thing. Okay, and then, sorry, it's really having trouble moving. Maybe if I get out of that now, I'll go back to it later. Okay, so what you guys need to do is this one, a sales forecast. Okay, you have to start with that and then move on to a projected purchase requirements budget. If you need to have, let's say, especially if your business requires buying things and reselling them, then this is a statement that you might need to have. And then if you're a manufacturing firm, then you need to have production budget. But if not, then you don't need this. And then your pro forma income statement. So this is very important. This is the bare minimum that you need to have. And your break-even analysis. Okay? So basically a computation of your sales and your forecast for your sales, computation of your income statement, and a computation of your break-even analysis. Okay, I'm going to stop